Today we're going to be focusing on two important developments. Firstly, the collapse of the French government, and secondly, looking ahead to UK interest rate decisions in 2 weeks' time. Good morning and welcome to Morning Markets. Yesterday we had an important development within France and their government where there was a vote of no confidence for Prime Minister Michel Barnier. The vote was 331 votes amongst the 557 members, and it was really led by the far right leader Marine Le Pen teaming up with the far left. Remember that the French government is a coalition where there's three parties with no majority and therefore pushed this vote through, which effectively removes the Prime Minister. So why the controversy? Well, in France, they're running a significant fiscal deficit of -6% of GDP. This is double the allowance of 3% from the European Union. And this really suggests that there's a lack of fiscal discipline within France. Michel Barnier, the Prime Minister, he had been putting through a budget proposal to reduce the deficit, announcing 60 billion of tax cuts and reduced spending, but that was viewed as being too aggressive and an opportunity for the two parties, the far right and far left, to push back on this. So looking forward, what this will mean will be that the President, Emmanuel Macron, will have to put in place a new Prime Minister, but very difficult given the coalition government. Regardless of this, as Kevin highlighted on Monday, the Eurozone is set to see materially lower interest rates given that inflation continues to trend lower, and that should be really supportive for the region and for the stock markets. We saw European equities were actually positive yesterday. Across the channel here to the UK, thinking about interest rates and the next Bank of England meeting just 2 weeks away, we heard from the Governor of the Bank of England yesterday, Andrew Bailey, who highlighted that still expect interest rates to move lower over the next 12 months, and his expectations are very much aligned to market pricing, expecting interest rates to fall by around 1% over the next 12 months, so that'd be 0.25% cuts in interest rates, which would put the base rate at 3.75% by the end of next year. He did highlight that he would be slightly cautious, however, recognising that inflation remains stickier. And this is somewhat that speaks to the projections that came also yesterday from the OECD. This is an intergovernment organisation which expects the UK to have stickier inflation relative to peers, the likes of Europe and also the US, but also expects growth to accelerate from 0.9% this year to 1.7% this year, and therefore expect interest rates, while to come down, but to be higher than what we have in, or expected to have within the European Union, but also in the US. That's everything from us today. Thank you for watching, and we'll see you tomorrow.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.